Jerome Powell, was it a year ago, said that he could see maybe there's more than one reserve currency. I don't know exactly what that means, but do you think there's a case where the U.S. sees what's going on and rather than being a victim of this situation decides to sort of preempt it or move in advance of that and tries to revalue gold on their own or something like that?
Yeah, I do. I think there are ways out of this fiscal situation. It's effectively a dollar devaluation. That's in the cake at this point. It's a question of, I think it was actually Putin who said it. It's like, if there's going to be a fight, the best thing to do is pick the time and spot for the fight, right? Where it's most advantageous to you. If there's going to be a devaluation, why not use it to your, pick the time, pick the spot, use it to your advantage? Because the devaluation's happening. That has to happen given the debt and everything we talked about before. There is a financial accounting manual for Federal Reserve banks. It's a public document. Latest update was April 2024. You can Google it. Section 2.10 says the president can instruct the Secretary of the Treasury to tell the Fed to revalue the gold, U.S. official gold. And then the accounting treatment of that is makes a deposit into the Treasury General Account, or TGA, which is just the Treasury's checking account they can do whatever they want with. So, president could say, listen, revalue it to $20,000 an ounce, every $4,000 per ounce, given 261 million ounces of official gold roughly. Every $4,000 is $1 trillion. 20,000 an ounce is 20 trillion into the TGA, 5 trillion into the TGA. Buy back the long end of the curve, devalue the dollar, fund industrial policy, reshore. There's a lot of leeway, things you could do with that basically take a U.S. debt crisis off the table, position the U.S. economy for growth, sort of anesthetize the bond market, as I've said to clients.
How does that solve the debt crisis? Because 5 trillion is a drop in the bucket to the 35 trillion of debt, and then you've shot your shot. Now you're out of the gold.
Well, you don't. The gold doesn't leave. It's just an accounting treatment. The gold never moves in the vault. It's just money creation, pure. It's just straight money creation with no offsetting debt. So let's say there's 35 trillion in debt. The Treasury market's 27 trillion, the nets and various Xing out. Okay, so you can buy back 5 trillion overnight, all at the long end, basically, all the way down. Maybe it needs to be more than 20,000, maybe it needs to be more than 5 trillion. By doing that, you're going to be replacing bondholders with cash. They're going to go out and they're going to buy something else with that cash, freshly printed $5 trillion. Being injected into the economy. You'll be growing the monetary base by $5 trillion.
Yeah, so the GDP would skyrocket.
GDP skyrockets, inflation skyrockets. Fed's going to probably have to maybe do a little bit of QE in there, but maybe not, because if you buy back the long end, there's no market. The long end is no longer a market. It's basically yield curve control. And then once, by virtue of reducing the debt, removing the long end blowout as a risk, then you can do some things on the fiscal side, whatever. GDP's already going to be skyrocketing anyway, inflation will be skyrocketing, and you end up with debt to GDP maybe back to 60, 70%. Now the Fed is in a position where they can raise rates to fight inflation. They might need to do some creative things.
Inflation would be so high. I mean, if you raise gold to 20,000, the whole world benefits from that.
Yeah.
Russia's going to benefit, China's going to benefit, and so now you have all of this money globally that's going to be sloshing around. And based off of sort of the way it's been going, maybe a lot of that capital comes to the United States.
It could.
So then we have massive inflation, right? You mentioned the Spanish Empire, right? So they went and discovered the gold in Peru, or the silver, brought that back, created massive inflation, right? So
that's in the cake, though, right? Like I was talking with Dylan LeClaire yesterday. It was. We had a 25 to 30% aggregate inflation over 2 years, and debt to GDP didn't move, right? Debt to GDP was 121, it's 122% now, which tells you something really important. The inflation shock playbook that they were trying to run, inflation shock financial repression playbook, 25 to 30 wasn't enough. It needed to be 50, 60, or 60, 80% inflation for 2 years. And now because they were not brave enough, not courageous enough to do it right the first time, now it has to be like the 60, 80, those types of inflation numbers in a compressed period of time. That's what we're dealing with here, because the debt and deficit levels are so high, and that's unpleasant, et cetera, et cetera. But Israel had 200% inflation for a couple of years in the 80s. Like, no zombies, no collapse, no, it just And
yeah, and I mean,
it's a smaller economy. But that just goes to show, like, it can be done. You know, it will be tricky, but we're going to have high inflation.
You reference a lot American with Argentine vibes is how you say it, right? So if you look at Argentina, who's had triple-digit inflation for a long time, I haven't been there, but according to many people I know who have, our friend George Gammon was down there recently. He's like, you wouldn't know it. You wouldn't know it when you're down there.
The only people I talk to that equate like really a period of really high inflation with like collapse of everything and zombies and all this stuff are Americans, and particularly Americans, you know, in the financial centers. Like, oh my God. Well, yeah, of course they're like, oh my God, because the real value of their bonds goes poof.